Thursday, February 6th, 2020, Maneco 64, home of alternative economics and contrarian views. This morning, I will talk about hyperinflation, how it was baked in the cake right after the 2008 crisis. I'm going to look at how the stock market fared in Germany during the Weimar hyperinflation. I'm going to reference a pocketbook of gold, a survival manual for monetary mayhem by Jim Sinclair and Peter Carlin. They predicted this all along. This book was published in 2010. So all the things they said in the part I'm going to reference is happening in the system. And I'm going to quickly reference this book, Fiat Money, Inflation in France, how it came, what it brought, and how it ended, by Andrew Dixon White. Another example of hyperinflation, this time in France, of course, about 150 years before the Weimar Republic, of course. Before I start today, I'd like to say that one of the major objectives of this channel is to try to expose the central banking system. And why? Well, because I don't think it's inducive to free markets, to freedom, to prosperity. So we've got things like end the Fed mugs, shut down the Bank of England mugs, end the ECB mugs, t-shirts. We got Billy mugs as well in our Teespring store. Have a look. It helps the channel. Let's start with the markets this morning. Quickly go through the markets. It's just before 8 a.m. Right now we've got spot gold at 1558.50, up just over $2. High has been 1560, low 1552. So gold seems to have held the 1550 for now, consolidating. Silver is still doing relatively well here. We're at 1771, up 10 or 0.6%. The stock market doesn't stop going up. I know we had a correction earlier in the week, but it seems like, yeah, it's just melting up right now. We're up another 200 this morning at 29,493. That's the Dow future. S&P is up another 19 at 33.53. NASDAQ 100 future is up 71 or 0.75% at 94.37. Before I go into the foreign exchange, let's show you a chart of the Dow. This is a weekly chart going back to end of 2015. I mean, just look at what the market's done this week. That doesn't look natural, does it? That bar there, that green bar, how it's just crazy, as I've been saying. But that's what happens when you've got central banks out there helping out and making sure that the markets never correct too much. People jump on the bandwagon. So let's look at the foreign exchange market. Sterling below 130, down about 0.15%, 129.82. Euros rebounded a little bit. Dollar strengthened yesterday a bit. Euro dropped as well with sterling. Euros just back above 110. Dollar is unchanged against the yen, 109.88. And dollar is also down slightly versus the Chinese currency at 697. WTI is bouncing back up. It held the 50 level. We're now at 51.92, up almost 2%. Brent up 1.5% at 56.19. Bond market, 10-year yield up 1 basis point at 166. So here too, we've seen yields back up. We got down to 160 earlier in the week, maybe a little lower. So now let's have a look at why hyperinflation has been baked in the cake since 2008. And I'm not bragging or trying to be clever. I've known since '02 that eventually this is what we're going to have. And why is that? Well, one of the reasons was Bernanke's helicopter speech, the fact that a central banker was telling the world that they were not going to let things deflate, that they were going to print as much as they needed to, his famous helicopter speech. But I wanted to reference this book here. And this was published in 2010, Pocketbook of Gold. And this is at the end, chapter 6, looking forward. And they've got a little comment or quote by Ludwig von Mises in the beginning of this section. I'll go through that. This is what von Mises said. It is impossible to grasp the meaning of the idea of sound money if one does not realize that it was devised as an instrument for the protection of civil liberties against despotic inroads on the part of governments. I would add bankers as well there. Ideologically, it belongs in the same class with political constitution and Bill of Rights. So let's have a look at what Jim Sinclair and Peter Carlin had to say. And Jim Sinclair, if you want to look at his blog, it's jsmindset.com. I've been following that blog since 2002, and Jim Sinclair. So let's go through this. And I'll go through the section, and you'll see why hyperinflation has been baked in the cake, or QE to infinity as well. The fundamental basis for the crisis the Western economies find themselves in is the creation and dissemination of over-the-counter derivatives. There you go, derivatives. Gargantuan risk was taken, then obfuscated and hidden, while personal bonuses were purloined from phantom profit. And they're still being purloined as we speak. The monetary aggregate created by these opaque, uncleared instruments is so large now that hyperinflation appears to be the only way to try and forestall the threat of an economic deflationary death spiral. Central banks are trying hard to do this, and with good reason. If the true value of OTC derivatives, that's over the counter, these are the opposite, not the opposite, but they're not like exchange traded derivatives. These are not publicly, we don't get public information on them. So if the true value of OTC derivatives were properly assessed, every market in the world would close the next day. FASB, F-A-S-B, FASB, and the BIS are aware of this and are assisting in the suspension of proper valuation in the hope that inflation may whittle down some of the size of the problem before markets demand a proper valuation. So FASB, of course, we've also had FASB 56 introduced in October of 2018. I think this FASB 56 is part of hiding all this because it also allows big corporations that deal with the US government to not have to report a lot of their accounting, and they use the national security excuse for that as well. Probably also related to the missing 21 trillion that Catherine Austin Fitts talks about with Dr. Mark Skidmore. But yes, FASB 56, FASB, and the BIS, Bank for International Settlements, they're working together to keep this down. They changed some of the rules regarding derivatives, especially mark-to-market. The banks don't have to mark their positions to market. They can market to model. So we've gone from having a quadrillion in derivatives back in after '08 or around that time of the crisis, and that's a notional amount, to now they tell us that it's only 600 trillion, but it's a lot more than a quadrillion, which is 1,000 trillion. The massive issuing of OTC derivatives has created a new, untested, unregulated non-transparent monetary aggregate without rules and without a history. This is not good. With over $1 quadrillion worth of OTC derivatives, some of which are worthless, managing the problem is a monumental task that will need a monumental amount of inflation. By inflation, they mean all the QE, all the help for the repo market, the zero interest rates, negative interest rates. $200 trillion of this problem sits on the balance sheets of just 5 US banks. That's true. You can go into the OCC website and have a look. It's public information. Even a small default rate could kill most of the world banking system. As Harry Schultz reminds us, and I quote Harry Schultz, if 4% of derivatives are at risk and 10% of those bets go bad, you've wiped out all the bank's equity and they go to zero. Additionally, the majority of OTC derivatives are geared for a low or lower interest rate environment. That's important as well here. No wonder they want to keep rates so low. It's not because they want to improve the economy, because people, we know already that it doesn't improve the economy. Look at Europe, they got negative interest rates. You ever wonder why they keep rates so low? That's why. When that changes, interest rates, as it must, the backlash could be catastrophic. Gold is responding to these factors. As a result of this economic mess, it is highly probable that living standards in the Western world have peaked for decades to come. How right they were back in 2010. The citizenry will end up paying for the OTC derivatives mess. Another comment that makes a lot of sense and is completely right, and they're still paying for it. It will be costly and it will take a generation or more to clear. So we've had a half a generation, I would say, and we're still clearing it. If you consider each generation about 20 years or a little more. Clearing the problem, however, is a road littered with political obstacles that could bring war and destruction. We should not forget the political outcomes of hyperinflationary economies over the past century. The precedents are worrying indeed. Yeah, I think they're thinking about Weimar Republic. So let's go. Continue here. The banking system, if it survives at all, will be significantly changed. Here's a part where I think some of the predictions they made haven't gone really according to what they thought, but it doesn't really matter. The important thing here is the hyperinflation. For America, the upcoming legislation defining the powers of the Federal Reserve as the umpire of financial entities can only be described as titanic in all that the definition means. It is still in the blueprint stage, but blueprints and buildings do have similarities in the final product. The basic elements formulated have the following aspects. There will be a secret club of financial institutions that will be considered too big to fail. That's right. We do have the too big to fails that are regulated by the BIS or the Financial Stability Board, which is part of the BIS. Not sure they're secretive, a secret club. They probably act in secret, but we know the list of the too big to fail banks. So the public will not be informed of who the members of this private club are. Well, I think we are being informed. That's why I said not all their forecasts were right. I think the public, it doesn't matter because the public is not aware of this, so they can make it public, hide it in plain sight. A fund will be established by taxing these financial institutions in good times to fund and protect them in the bad times. That didn't really quite work out. I think they're just taking it off the taxpayer. Taxpayer is so blind that they can afford to do it. So there's no fund. 4, the Federal Reserve has the power to determine and therefore change what the definition of solvency is. Yeah, I wouldn't disagree with that. So I'll continue. The not so inviting conclusions of this are: 1, if you're a member of the Too Big to Fail club and will have to pay for rescue, then why not take wild risks? Because if you are good, you will be punished, and if you're bad, you'll be rewarded by rescue, which so far pays the losses. That this fund will never cover the degree of risk now or in the past being played with abandon. Yeah, the Too Big to Fail. That's the thing as well. They know they're going to be rescued, so they keep playing this game of derivatives. The other thing I would say, even if they do things wrong, they're punished by fines. That doesn't really affect their businesses. We've seen JP Morgan. I think they've paid over 40 billion in fines since 2002. 2, this means if the plan is enacted, that in the end, the size of the disaster now or in the future will be paid for by innocent citizens in the form of federal debt. Yeah, we can see that. This plan, if enacted, will guarantee the financial capacity of the present mountain of financially bankrupt OTC derivatives outstanding that are held or shared by the Too Big to Fail club. And this club is international, by the way. It's not only American. 3, by omission, the too small to matters are flushed. Those are the smaller banks. So let's keep going. Not over yet. As the government becomes more involved in financial affairs to protect specialized private interests, that's Wall Street, risk is transferred to the public domain through the federal debt. And this is happening all around the world, in the UK included, by the way. All the countries that house these Too Big to Fail banks. The assumption of risk by the state will in turn endanger the credit worthiness of the state, as it once did and still does the banks. As debt is assumed and money printed to mitigate problems, currencies will suffer in an attempt to avoid outright default. The de facto financial failure of entities loosely tied to and perceived to be ultimately guaranteed by government, like Fannie Mae, Freddie Mac, Dubai World, may presage an era where governments themselves begin to default outright. Money printing is both an effort to forestall default on the massive debts government has assumed from the private sector and quasi-public sector, and an attempt to rein in the real cost of unfunded future liabilities. Yeah, they're running like at 130 trillion. Check out on the US debt clock, by the way. Stimulus packages are politically driven to postpone the crisis beyond the next election. Well, we can see now that's happening everywhere in the world, in the US as well. They're planning for more fiscal stimulus through tax cuts and no government cutting of government spending. But it should be recognized that there has been no resolution to the financial crisis itself. This is why liquidity will not be drained and quantitative easing will not be curtailed in the foreseeable future. Well, we'll stop here for a second. They try to curtail it and unwind it, and we saw it happen, and they're starting again. Even though they don't call it QE, balance sheet is increased by almost $500 billion since September. So yeah, they can't, it's QE to infinity. They can't stop it. And they are also now having to intervene in the repo market. It's a mess. This is all a result of what happened in 2008. It's all because of these OTC derivatives. The quality of sovereign risk, once considered amongst the highest quality credit risk, will be increasingly called into question. The financial crisis, which has caused banks and others to gorge themselves on government bonds in the drive for safety, has also increased their exposure to the credit worthiness of government. But how do these supposedly risk-free instruments retain their quality when government continues to assume ever larger debt, bail out seemingly infinite toxic assets, and print even more money? Now that some governments are becoming the most significant purchaser of their own debt, that's debt monetization, that's what the Fed is doing, Bank of Japan's doing, a negative feedback loop is likely to ensue. The crisis has pushed the government bond market higher, lowering the cost of debt servicing. At the same time, the size of the debt has exploded. Sound familiar? It sounds like the exposure of a subprime mortgage borrower on teaser rates. You can always refinance. Sovereign risk may soon become something other than risk-free. The government bond market is now a massively coiled spring that has been pushed higher and higher. When it turns, and they say, think reset, government debt servicing will explode. At the same time, the turn in interest rates will decimate the rice paper balance sheets of banks holding trillions of dollars of derivatives. Yeah, remember that these derivatives are dependent on lower interest rates. When interest rates turn and the derivatives fuse is lit, the bomb may detonate for real. The now even bigger, too big to fail banks, they're even bigger, will have to be rescued again, but this time by a completely insolvent state. All of this is a clarion call to gold, as gold is the ultimate restorer of balance sheets. So, and that's why it's so important that you have some gold, if you can, as a protection. Before I finish, I know it's going on for a while, this video, but let's look at how the stock market did during the German hyperinflation. There's an article here from Business Insider from 2011. Here's what happened to stocks during the German hyperinflation. So I'll just show you a chart. The right-hand axis is the German stock market in US dollars. You can see that, for example, in 1920, it was trading around 20 or so. It dropped into 1923 to below 5, so it wasn't doing very well. And then during the hyperinflation, it actually went up to almost 40 and settled around 27. So it did fairly well in dollars, and dollars, don't forget, back then were as good as gold. So this is the price of the German stock market in gold. And also left-hand axis is in Reichsmarks, or the German currency, and you can see how well it did. Actually, it was inflated away. So yeah, stock markets can do well in a hyperinflation. Not all stocks will do well, of course. I don't think banking stocks are going to do very well. Stocks related to the financial, to the paper bubble. Companies that do activities in the real world with tangible goods, they will probably do well. But the other thing about hyperinflation that I would say, it will hurt everyone because it will destroy the currency. And we know that in a modern industrial economy where we depend on currency and money to interact, as we have no barter, people have their own specialized jobs. We don't have people owning small farms as a general rule where they can survive. It's going to be devastating for the economy. That's what you need to think. That's why, yes, the stock market might hold up, but everything else is going to go down the tubes. The economy is going to be devastated. But one positive about this is that hyperinflation happens very quickly, and the recovery can be quite fast if the right things are done. And you can bet that gold and silver are going to be an important part of getting the system restarted again, the monetary system, the economy. And am I saying we're going to go back on a gold standard? Some people think that I'm pushing for a gold standard. Not necessarily. As Jim Sinclair and Peter Carling say, Gold is the ultimate restorer of balance sheets, and that's what I mean. So as I said, it's baked in the cake, the hyperinflation, and has been since around 2009. And why is it taking so much longer than it took in France? In France, it took 5 years for the hyperinflation or the assignats to be destroyed. Well, I think it's because the whole world is doing this experiment. Back in the 1790s, it was only France. But the consequences are going to be much worse than in France in 1795. I mean, the inflation that we've had now is astronomical compared to what they did in France. If you enjoyed this video, please hit the like button. Think about subscribing to the channel if you haven't yet. Please share this video far and wide. And you can also follow me on Twitter, BitChute, Facebook, Steemit, and DTube. I wish you all a great day. Take care. Bye.